In this presentation, I want to give you sort of a brief overview of what I expect you guys to cover in your final business opportunity recommendation, or what I call the go, no go recommendation. You're going to see that the PowerPoint is fairly similar to the one that you did for step 13. The big changes where we originally had a funding proposal, you'll now have a funding agreement. And I've added a slide on capital budgeting metrics. Aside from that, you're going to want to go through and explain things the same way. So you're going to want to show your sensitivity analysis. You're going to want to show how that tracks over to your scenario analysis. And so again, to the extent that you had any sort of issues with any of those, you want to clean them up for this presentation. You're going to make sure you have your operating cash flows and your cash balance charts in and working this time so that we can see everything. To the extent that there are any mitigations to anything, then you want to reflect that in there, right? So again, you've got likely versus bad, likely versus good. You see how that kind of goes. On the funding agreement, you'll see that it now reflects exactly what we agreed. So I agreed a $900,000 debt at 8%, 10 years secured amortized. I got $500,000 in equity, 40% stake in the business, and using the likely case that came out to 32.41% cost of equity. So you want to reflect all of that information so that we, looking at the project, can kind of understand where everything went. And then I've added a box at the bottom, which is the weighted average cost of capital, what the debt weightings are, right? We needed 1.4 million total. So 9/14 or 900,000 came from debt, 5/14 or 500,000 came from equity. I calculated my WACC using a 35% tax rate. And so this becomes the formula. It is the debt weighting times the agreed interest amount I had, times 1 minus the tax rate. So that's all the debt side of it, plus the equity weighting times the cost of equity, and that comes out to the 14.95%. Okay. Then the last thing I have are my capital budgeting metrics, and again, there's a video that explains to you how to calculate all of that. And separately, then you're going to want to interpret those things, and you would interpret them in the same way as that was discussed in class. At the end of the day, what it comes down to, 3 different interpretations, all right? 3 different metrics: payback period, NPV, IRR. Again, net present value, NPV, that is the gold standard. And so we're going to start with that, all right? Our likely case says the net present value is 1.25 million, which is positive. Our good case is obviously that. Our bad case, it's negative. So here's where things sort of depart a little bit from what you may read in a book. We have a range now of net present values that goes negative. In the bad scenario, it could go negative. It's not a lot negative, but it could go negative. Now, the NPV rule says that if the NPV is positive, you take the project. If the NPV is negative, you reject the project. But it doesn't discuss what do you do in these scenarios. And so realistically, what I would be doing here is saying, I'm going to judge initially the project on the basis of the likely NPV. And I see here I've misspelled likely, sorry. And so generally I would say we would accept this project. If, however, we needed to rank this project against others, then if there were other projects that had sort of a similar level of NPV, but maybe their bad NPV was less negative than ours, I'd prefer them to this. On the other hand, if they had similar levels of likely NPV, but their bad was, the other ones had a much worse bad NPV, then I would probably prefer those less. So it's what goes on in your likely is sort of your initial should we go or should we not go. But these bad and good pieces of information help you rank from an NPV standpoint, that you may prefer one over the other completely separately than based purely on that NPV, that likely NPV. Second thing we would look at, payback period. Here you needed to have in mind something that said the project needs to pay back within a certain number of years. in order for it to be a good project. Generally, 5 years is kind of a range that a lot of people look at. Different companies have different rules. You can see that ours does fine under the likely. It's a little bit close, but in the bad scenario, it never pays the money back. That is a disturbing thing. It's one thing to say, well, it doesn't get it done in 5 years. It's another thing to say that it never finishes paying the money back. And we know that because we only assessed it out to 10 years, and it went the entire 10 years. So payback period would be telling us it's a good project, but just barely, right? And if things go south, you may not get your money back at all. So you would definitely want to consider that versus projects that were, either easily good payback periods, or that they maybe were kind of similar in terms of their likely payback period, but in the bad scenario they do still eventually pay it back. So that's kind of how you would look at that. Internal rate of return, what you're doing is looking at that return and comparing it to your weighted average cost of capital. Remember, our weighted average cost of capital is 14.95%. So under the likely scenario, we're getting well above that, 26.66%. Pretty good return. We would be happy with that. Obviously, in the good scenario, we really blow it away percentage-wise. Clearly, in the bad scenario, we would reject this. So, interestingly, for this project, in the likely scenario, all three metrics tell us we would accept it. In the bad scenario, all three metrics tell us we would reject it. And of course, if the likely is going to accept it, the good's going to accept it. And so it's really the bad scenario that we would then focus on a lot in terms of ranking. And there's no real rule here. This is where there is a bit of judgment in terms of how do I take that bad scenario information into consideration. Again, you're not going to find that perspective in a textbook anywhere. You're not going to find that perspective out on the internet anywhere. But the bottom line is that we absolutely consider these different scenarios in terms of making the decisions about how well we like the projects. We simply can't ignore that things could go badly, and if they go badly, how things would turn out. And so that's kind of where we are on that. So those are the things I want you to do. And at the end of the capital budgeting discussion, you would be expected to come back with some sort of at least a go, no-go recommendation. And so, for example, for this project, I would say that my no-go recommendation is that we would go ahead with the project. That if I didn't like it, I would say it's a no-go. We should not go ahead with it. But we should go ahead with the project based on the likely metrics. But in terms of how strongly we prefer this project, we're a little bit concerned with how bad the bad metrics are. And so potentially, if we had to choose between this and other projects, from a ranking standpoint, we would probably rank projects that don't have as poor of metrics in the bad scenario. We would rank those above this. So bottom line, we should probably go ahead with it if we've got enough capital and everything, and it's all we need is a go no go decision. If we have to make choices, then you should pay attention to the bad metrics a little bit more here in making your choices. And so that's what I would expect that you guys would be doing in terms of that final recommendation. Again, I do want you to, since this is the last presentation, I do want you to go through and kind of discuss everything in all the slides as though we're sort of seeing it, maybe not for the first time, but we're seeing it as a full package one time, so that everybody gets the benefit of that before we get to your recommendation. That's all I got. Thanks.